Hello everyone, it is Sterling here from Trading Forex Live, home of the bank trading strategy, and today we are going to talk about two different topics that I get questions on all the time. Number one is, can you apply the bank trading strategy to other markets outside of the Forex market? And then number two, is the bank trading strategy solely traded on just the 15-minute chart? You guys know we focus on the 15-minute chart. The video I put out 2 weeks back covering the confirming entry is specific to the 15-minute chart, but can it be applied to other charts? Can you see manipulation on longer term charts, say? And that's what we're going to cover here today. So in order to do that, we're going to go over to a chart of the S&P 500. It's an example of trading manipulation on indices, and we're going to show it on two different time frames, both on the same chart. So the first thing that we're going to show is we're going to see how a stop run preceded the entire move to the downside. This is one of the largest falls that we've seen in quite a long time in equities. If you go back, just kind of zoom way back here on the charts, you can see that it's been quite a while since we've seen this large of a drop to the downside. And what precedes this move is a stop run. So we'll go back in, zoom back in here for you guys. And what do we have? Well, we have a clearly established high. The market comes up, creates a false break above that high, and then confirms down. Now, obviously, you have to have a way of quantifying what a true stop run is. How do you quantify that that was a true stop run? Well, I personally use the confirming entry. Again, something we talk about quite a bit. That's one way of quantifying that that was a stop run. But the bottom line here is that you're seeing the false break of a previously existing high, and that's what's preceding the fall to the downside. Is this something that is a rarity, something that's not very common? Well, go back and look at the charts. You'll see it happen over and over and over again. What do we see here today? Well, let's zoom into the 15-minute chart, and I'm actually going to illustrate what happened here today. We see the market come up. It breaks above the previous day's high, creates what we term as a confirming entry back down, confirms to the downside, pulls back, providing the entry, and that is what precedes this day's move. So not only did it precede the market move for the longer term charts, the daily charts, providing a very good indication that the market's going to fall longer term, but it's also preceding these intraday moves. The bottom line is manipulation can be spotted on not only other markets, because all markets function the same. It's a searching out of liquidity, and liquidity, if banks have to search out liquidity in the largest financial market in the world, which is the Forex market, wouldn't it make sense that they have to search out liquidity in these smaller markets such as the futures market, even in the bonds market, that the searching out of liquidity in a market as large as the bond market, U.S. bond market, is something that can be seen. So not only, again, is it spied in other markets, but it's also spied on other time frames such as what we just showed a minute ago, which is the daily chart. Now, why is this manipulation occurring? Why is this false break preceding, or often preceding, the move for the day? Again, it goes back to the searching out of liquidity. If you have the desire to short the market, and you're a major controlling force of the market, simply selling your position is going to cause a tanking market. As the market begins to fall, you get a worse and worse fill price, and the desired goal is not achieved. The desired goal, obviously, like any of us, is to sell at the highest price, buy at the lowest price. As you create or allow the false break above the previous highs, that is inducing a great deal of buying pressure. You're stopping out anybody that's short, one type of buying pressure, and second, you're inducing buying pressure on a breakout of the previous highs. Two simple ways of looking at the buying pressure that's created. As that buying pressure is created, allows smart money to sell into the buying pressure. Essentially, they're creating that liquidity, creating their own liquidity to precede the drop to the downside, the fall to the downside. Here's the entire principle behind what we do. The fact is, the reason the retail market has a hard time producing any consistency, and I would urge you to look at your own consistency of this market and see if this makes a lot of sense. All strategies that retail traders use rely on looking at the market and then trying to place rules on a market that they don't control. Maybe that's with an indicator, maybe that's an EA they've designed, a chart pattern, a price pattern. They're saying that this means something, whether that be, again, a chart pattern, price pattern, in different rules that dictate what an indicator is doing. They're applying rules to a market that they don't control and then trading those rules. What we're doing is we're saying, you know what, we don't control this market. So therefore, us applying rules to a market we don't control is not the best way to produce success. That's proven. The retail market has proven that. With all the losses, the retail market has proven that point. So instead of doing what everybody else is doing, we're going to say, you know what, let's look at who actually controls this market. That would be the 10 largest banks. They have a major controlling force. 10 banks control 80% of the volume. That's not a hard number to find. You can go into Google, type in Forex, and find the first Wikipedia link, and you will find in that first link the 10 largest banks and the controlling force that they have on a volume basis. So if 10 banks control 80% of the volume, then the next question is, where are they going to be finding liquidity? How are they going to be entering the market? Are they just pressing buy or pressing sell? Well, banks are multifaceted. You know, they have general order flow, they're market makers, they have speculative trading, high frequency trading. So it's not as simple as just saying this is how the banks trade. But there is one way of very simply quantifying where a likely entry point was, and that is by identifying points where high liquidity is going to be located, or points of high liquidity in the market. And that is often around major previous turning points. So when we identify the manipulation of these high liquidity areas, who has a desire to find liquidity? Well, you and I could care less about liquidity because there's always enough liquidity for us to enter the market. The people who care about liquidity are those that have and move enough money to dry up liquidity at a certain price level. And the only people that have the ability to do that, the only institutions that have the ability to do that, are smart money, the 10 largest controlling forces in this market. Again, the 10 largest banks. That is who has the ability to dry up liquidity, and therefore they have the need to search out liquidity. So when we identify them searching out this liquidity, we have a very good indication of the next market move. Again, they control the volume, therefore they do control short-term market direction. So it goes back to the foundation. Instead of trying to apply our own rules to a market we don't control, what we do is we say, you know what, we don't control this market, therefore we're going to search out those that do, and we're going to track them to the best of our ability using the simplest way possible. Simplest means the easiest to repeat, and therefore the most consistent way, and that is identifying areas of liquidity, waiting for the manipulation at those points, and then tracking smart money based on the way that they have to trade, which is searching out for that liquidity. And that's something that I don't care what market you're looking at, you'll always find it. Let's go back to the Forex market here, and let's look at some recent examples on a daily chart. What precedes this major move to the downside? If you zoom out here, and I know the chart's a little bit cluttered, but what precedes this major drop to the downside? Well, if you look at this, why do we have a false break? Why does the market create this false break here above the previous highs to precede that move to the downside? You go into your daily chart in the pound. What happens again here? We have what? We have a high established. The market again comes back into that high, creates the false break of that high, and that's what precedes this large drop to the downside. So whether you're looking at the 15-minute chart, the hourly chart, or the daily chart, whether you're looking at short-term intraday moves, weekly moves, or monthly moves, the bottom line is manipulation can be seen and it can be traded. It is the best way to track liquidity, and it is the best way, therefore, to track smart money. It goes right back to a trade that we took here today in the room. Why did we take this trade today in the room? Well, we identified a point of high liquidity, which was these lows. We identified the false break of these lows, and this is where I was taking the trade at 68.30 in the room. Now, we have yet to see really a major profit from this trade. It's a short-term trade. More than likely, I'll be closing it out around 5 o'clock using our session change rule, which is I don't carry a trade going through a session. At 5 o'clock, I'll close this trade out. But the bottom line is these setups are designed to produce very high risk-reward scenarios. They're designed to often catch the turning points in the markets, whether it be a turning point from a low or a turning point from a high. And it can be seen, that can be traded every single day. So if you're struggling to produce consistency, trading mainstream strategies, I'd urge you to look at why those mainstream strategies are failing. The simple fact is they don't give any credit to the controlling forces of this market. And if you don't understand manipulation, my firm belief is that you either trade manipulation and understand it, or you become the victim of it. And very often traders go their entire career never understanding how they've been the victim of manipulation. And it's not a searching out for trying to screw the retail trader. It's very simply the searching out for liquidity. And that's what causes the trader to become the victim of that searching out of liquidity. And again, most people go through their entire trading career never even realizing this, never even giving any indication to a very simple fact, a simple fact you could find in 5 minutes. There's 10 banks that control 80% of the volume. You either know what they're doing or you don't. And if you don't know what they're doing, you're going to be the victim of what they do, which is, again, create that false break, create that manipulation, and that's often what traps traders, and often what is the demise of most traders. So if you have any more questions on this, feel free to check out the site, daytradingforexlive.com. Ton of information on the site. I will link below this video to the confirming entry video, whether you're watching it on the site or whether you're watching on YouTube, so you can check out that video as well, as I know that'll be helpful to you if you want to learn more about the confirming entry and the entry technique I actually use when the market comes into these predetermined levels, levels that I choose in advance. So that is, again, going to do it for this video. I hope you enjoyed it. Until next time, guys, happy trading.